Is it time now to sell Microsoft? The company has run up 42% year to date, or should we be looking to buy or hold the stock? We're going to find the answers in today's episode. We're going to take a look at the historical performance of the stock. We're going to jump into their revenues over the last 5 years. We're going to look at what they believe going forwards their revenues will be. We're going to take a look at that all-important dividend safety. We're going to take a look at some very, very important financial metrics for the company. And as always, we're going to end the episode with our stock valuation model. What is the intrinsic value right now in the market of Microsoft? And what is our acceptable buy price with our margin of safety? So let's jump straight in. As I mentioned, 42% year to date. And for those who have been holding the company for over the last 10 years, you will have an incredible growth of 880%. Now, that is one of the highest growth stocks that we have reviewed on the channel. It is currently sitting towards that 52-week high, and the current yield not massive, as it's not really a high dividend yield stock, but at 0.8%. In my opinion, the yield is just a bonus to that capital share price appreciation. Now, taking a look at their revenues over the last 5 years. Now, for a company like Microsoft, we would expect to see quite high growth in their revenues. In June 2018, they reported revenues of 110 billion. Now, June 2022, almost 5 years later, nearly double that, just under 200 billion worth of revenue. Now, we want to see, does that translate to the bottom line? That net income was reported in June 2018, 16.6 billion. And look at that, they have more than doubled. So it's grown more than that revenue increase at 72.7 billion. So that is really good to see for a company like Microsoft. And while we're still on the topic of the revenue, I will just show you a very recent report where the CEO expects and has set a goal of 500 billion in revenue by 2030. So if we just take a look at that, it's expecting in the next 7 to 8 years to be more than double the current revenue, which is insane. And that is a lot of growth. Now, that's obviously what we want to hear as shareholders. Now, taking a look at the balance sheet and having a look at their cash versus their total debt. And if you've already know about Microsoft, you know they have a lot of cash. So currently their total cash and short-term investments is sitting at just over 100 billion in their latest report. It is lower than June 2018 when they had around 134 billion. But for me personally, that isn't something that worries me. And we'll touch upon that when we look at their ROIC and why that's important. Now, taking a look as we scroll down here, as I always like to analyze their cash versus their total debt, we can see here their total debt in June 2018 was 87.5 billion. And we can see they have paid off some of that debt. It's currently sitting at 79 billion. If this was any other company, I would then raise the point that we need to look at their interest payments, their total debt, and whether or not this will affect their dividend. But let me just say this, if we just take a look, if they really wanted to, they could pay off all of their long-term debt with their total cash balance. So that is incredible and probably one of only the few companies to be in a situation like this. Now, we've taken a look at their balance sheet. We're going to jump now straight into that dividend safety and some very important financial metrics. It should come as no surprise after just running through the financial statements that their dividend safety score is 99, the highest, very safe. Market cap 2.53 trillion, making it a mega cap. And obviously just behind, if you've heard, Apple, who just recently went past the 3 trillion market cap. Now, some very important key metrics. We will discuss some of this throughout the next slides. Dividend streak, 16 years without a reduction. Now, if you are expecting us to be heading into a recession, then these next 3 bottom metrics will be key. So they maintained their dividend in the last recession. There was no cut, but there was also no increase. They did have sales of negative 9% in the last recession. However, this was the average growth rate during this period. And the S&P 500's return over this period was negative 55%, with the return in the recession for Microsoft sitting at negative 48%. Now, just one thing to bear in mind is that when we take a look at the last 10 years, you have to be holding stocks for long terms if you want to see share price appreciation with these figures. If you were to suddenly sell because you saw a drop, then you would be missing out on the total gains of the market. Now, taking a look at that dividend growth increases, their latest increase 9.7% in September 22, so we are due an increase in the next 2 months. You've heard me say it. If you've watched my previous videos, you may be sick and tired of me saying it, but it is very important to understand you must be getting at least a minimum of 4% increase in your dividends, in your salary, in your other income producing assets. Otherwise, you are losing your purchasing power, as the US inflation rate over the last 40 years was 4%. Very positive to see 10% in the last 5 years, and we love to see double digits, 12% per year over the last 10 years. So very nice to see so far. Now, a word on the valuation on Microsoft. If you've seen my videos, you know dividend yield theory states that when a company's yield is sitting above the 5-year average, it is undervalued. When it is below, it is overvalued. So currently, this would show us that Microsoft is overvalued. Again, we don't look at any models in isolation. We draw our conclusions at the end when we've considered all the factors. Forward PE at 32.3. Again, the forward PE is above the 5-year average, meaning it is overvalued, again, in respect to this theory. And we can see here the sector PE comparison. Again, another sign of overvaluation, with Microsoft sitting at 32.3, with the information technology sector sitting at 24. Now, 52-week price range, probably one of the few stocks that we do take a look at that is sitting at that 52-week high. This does not mean the company is overvalued. Likewise, if it was at the bottom here in the 52-week low, it wouldn't mean it is undervalued, but it is a good metric to see. In terms of the earnings payout versus the free cash flow payout, if you've seen my videos, again, we only look at the free cash flow because the earnings is susceptible to manipulation through accounting, which is why you often see differences in the percentage figures. But let's take a quick look. As you know, I like to see below 60%, as it means companies can continue to pay that double-digit dividend. So what we can see here is in 2013, 35%, in 2022, 27%. So we can see here it has varied over the last 10 years, currently around below 30% regardless over the last few years, and is expected in 2023. Now the free cash flow payout we can see, which I prefer to look at, again, similar statistics, similar metrics, 30% in 21, 29% in 2022, and again below 30% in 2023. So very positive to see. Now, likewise with the earnings per share, I prefer to see the free cash flow per share, but I believe the stories essentially mirror the same. 265 in 2013, 2022, 921, and we are expecting an increase on that in 2023 with regards to the EPS. Likewise, 293 in 2013, 869 in 2022, and 2023 is expected to be higher. This is why I like to look at least 10 years if possible, if the data is there, because it gives you a good sense of the company. If you were just to look at, say, 3 to 5 years, you may think there isn't that much growth, but when you look at the 10 years, it gives you a better idea and overview of a business and its performance. Now, sales growth, typically we like to see steady, moderate growth, 3 to 7%. You could argue for a company like Microsoft with nice growth year on year, 5 to 10%. Either way, Microsoft does not care. Microsoft is smashing the revenue growth, double digits over the last 7 years, and that's very nice to see. So, what we can see, the below here, in fact, is about 5 years of double-digit growth, but still very positive. What we can see here, the total sales, around 78 billion reported in 2013, 198 in 2022, more than double, and it is expected in 2030 to be 500 billion. So that is a very nice increase if this does continue. Shares outstanding, maybe surprisingly, Microsoft doesn't do a lot of share buybacks. Share buybacks are when companies return excess cash to shareholders. It has remained fairly flat. There are some years where they do share buybacks, but very, very minimal and not really much to say on this. Now, if you haven't seen my pinned YouTube video, what you'll see is I run through my 7 golden dividend metrics, with the return on invested capital being one of them. What I like to see is a minimum of 10%, as it means that companies are able to allocate their capital effectively and efficiently, and we can see here Microsoft do well above that, reaching 34% in 2022, which gives me strong faith in their management. Operating margins, again, above 12% is what we like to see, and above 5% on the free cash flow margin. From the data we've just gone through, this shouldn't surprise you. They have smashed that. They have got around 42% over the last couple of years, and we can see with the free cash flow margin in the mid-20s when really above 5% is what is expected for most companies. So they have smashed these figures. This basically shows you a lot about Microsoft. If they wanted to, it wouldn't even take them a day to pay off all of their debt. So this is nil. If you've seen my previous videos, you'll understand this metric. Essentially, the number of years it would take for the company to pay off all its debt net of cash on hand. If you don't know what EBITDA is, it stands for earnings before interest, tax, depreciation, and amortization. And this shows the percentage of a company's financing from debt as opposed to equity, which here is nil. Now, so far, I would say those are really, really good metrics for the company, Microsoft. But what we really want to find down to is we want to get to the bare bones and find out what is the intrinsic value. And with our margin of safety, what is that acceptable buy price? Should we be looking to sell, buying back when it is cooled off, and then re-entering? Or are we it better to effectively just hold? Now, and I'll explain at the end of the video what my situation is. Now, if you're enjoying the video, do smash that like button, do hit that subscribe button to get that content continually. And if you want to grab a copy of the stock valuation model, do check the pinned comment and the description. Likewise, if you want to join us on Patreon, again, hit that description and check it out. Now, Microsoft, the earnings per share, $9.23. Growth rate as expected by analyst estimates at 14%. We've got the average yield on AAA corporate bonds. The intrinsic value is coming to $180. Now, that may surprise you slightly, but it's only slightly lower than that 52-week range. And for those who have been tracking Microsoft, it shouldn't feel like too long ago that it was at that price. Now, the multiples valuation model, we have companies in a similar sector or size as Microsoft. We have Apple, Meta, and Adobe. We have our stock price earnings per share with the P multiples. Now, we have our average multiple, which we multiply by the earnings per share, gives us a multiples valuation of $358, showing some small upside to that current share price. Now, the dividend discount model, as you've seen, there are some nice growth with the dividends from Microsoft. Once we've got our yearly dividends, we can see the average growth at 10%. Now, I've gone a bit more on the conservative side. If we are to head into a recession, I've gone for around 7.25%. This gives a DDM price of $389, showing some nice upside to the current share price. Now, the DCF model, the discounted cash flow model, the final model, we have our free cash flows. We have the growth year on year at 12% on average over the time period. We've gone for around in line with analyst estimates at 14% forward looking. And once we use our discount rate, we get the present value of these future free cash flows alongside that terminal value. Once we add that with the cash and equivalents, subtract the total debt, and we get to our equity value, which we divide by the shares outstanding to get a DCF price of just under $380. As always, if you are enjoying the content, do hit that like button and do subscribe for more content. So the intrinsic value is essentially the average of the four models that we have just gone through, coming in at $326. So this is slightly lower than the current trading price at around $340. Now, typically, for a strong company with a wide moat, I would like a margin of safety of 10%. You could argue for a company as strong as Microsoft, you could even have no margin of safety. It does come down to the individual investor. So if you had no margin of safety, you would still be waiting at $326 for buying the company. For a 10% margin of safety, you would be looking to buy just under $295. And for those who are looking for a margin of safety around 20%, you would be waiting for around $261. Now, let me just show you, $261 is still within that 52-week range, so it wasn't too long ago that the share price was there. Now, me personally, I have shares of Microsoft and I will be holding. For me, this is a forever stock, and the only reason I'd ever sell if there was a change in my investment thesis, but I will be looking to add shares if I see the share price dip to around a 10% margin of safety, just under $300. Do let me know your thoughts in the comments as shareholders or as potential shareholders, or if you're sitting on the sidelines. Wall Street do forecast the price to have very minimal upside at the current share price, so they believe it will get to $347 over the next 12 months. So as always, let me know, are you looking to sell your shares? Are you looking to buy? At what price? As always, have a great day. Catch you on the next episode. Take care.